Today, we're going to be diving into the short-term rental loophole. This is a powerful tax strategy the wealthy have been quietly using for years, and now you can too. If you own or even consider buying a property that you're renting out for short-term stays, so typically 7 days or less, there's a special rule in the IRS code that can turn your rental into a business for tax purposes. This means you could offset your active income, like your W-2 salary, your business profits, or even your side hustle earnings with rental deductions. That's something long-term landlords usually can't do without jumping through some very strict hoops. And here's the kicker. You don't have to become a full-blown real estate professional to be able to take advantage of this. The short-term rental loophole is like a secret backdoor that most people don't even know exists. Quick question for you. Have you ever stayed in an Airbnb and thought, wow, this person must really make a fortune? Drop a comment below, because after today, you'll see how the tax side of this can be even more profitable than the nightly rates. Normally, rental income is passive, so that means that you can't touch your active income unless you qualify as a real estate professional. But short-term rentals under this 7-day average stay rule are classified differently. They're treated like an actual business activity. That unlocks the ability for losses to be non-passive as long as you materially participate. Here's where it gets interesting. I had a client, we're gonna call him Mike for privacy. He bought a small condo near a ski resort. Before, it was just another rental. But after applying the loophole, his $70,000 in paper losses offset his salary as a dentist. That meant that nearly $25,000 saved in taxes in just the first year. This is especially powerful for high earners. Why? Because losses reduce taxable income dollar for dollar. Think about the things you can deduct: the mortgage interest, property taxes, utilities, furniture and decor, maintenance and the cleaning, and the big one, 100% bonus depreciation. Depreciation is like the IRS paying you back year after year for your investment. Bonus depreciation, which is now permanent with the one big beautiful bill, you can supercharge those deductions in the early years. Now picture this. You're in the 35% tax bracket. So if I handed you $100,000 in deductions, that basically means you have a $35,000 refund. What would you do with an extra $35,000 next year? Take a vacation, expand your business, pay off debt? Think about things as we keep going. So how do you actually qualify? 3 big steps. 1, average stay must be 7 days or less. Think weekend Airbnb rentals, ski cabins, or beach condos. Just be careful, a few longer stays can throw off your average. Step 2, material participation. So the IRS has 7 different tests, but here are the 3 that matter the most. If you spend more than 100 hours and no one else spends more time than you spend more than 500 hours on the activity, or you're basically the only one doing the work. Step 3, hands-on involvement. That means responding to your guests, coordinating the cleaning, and managing the booking. So imagine a day in the life as a short-term rental owner. You're messaging guests, you're setting up cleaners, adjusting nightly rates. That all counts towards your participation. Do you see yourself as someone who likes being hands-on with property management? Or are you more the hands-off type? Because this loophole really favors those who roll up their sleeves. Let's run the numbers. So say you buy an $800,000 cabin with depreciation, furnishings, utilities, and other expenses. You could easily generate 6 figures in deductions. That's paper losses you can use against your salary or your business income. Okay, so now maybe $800,000 feels big. So here's another example. Let's take a $400,000 beach condo. Even at half the value, you could still see $40,000 in deductions, and this would save you about $14,000 or more in taxes. So see how this works at different scales? The principle's the same. Now, this isn't a free-for-all. Here are the 3 biggest mistakes that I've seen. Number one, allowing too many long stays that can kill your 7-day average. Mistake number two, outsourcing too much. If you can't prove material participation, then you're going to lose the loophole. Mistake number three, not keeping the logs or the records. The IRS loves documentation. I've seen someone lose out simply because they couldn't prove their hours. And don't forget, some cities like New York or San Francisco have strict rules or bans on short-term rentals. So make sure you're always checking your local laws. A few other things to keep in mind. Short-term rental income is generally not subject to self-employment tax unless you've provided like a hotel-like service. So make sure you have a cost segregation analysis done. So this will help you take full advantage of bonus depreciation. And above all, work with a CPA who understands these rules. I've seen two investors buy almost identical properties. One worked with a regular CPA who was unfamiliar with short-term rental rules. The other worked with a specialist, and the difference in their tax results was night and day. The short-term rental loophole isn't for everyone. But if you're in a high tax bracket and you're looking for smart ways to invest, this could be a game changer. Imagine owning a property that not only pays for itself, but also saves you thousands in taxes each year. That's money you keep in your pocket, money that compounds over time, and money that gives you freedom. If you want to reduce the taxes you pay to Uncle Sam using this loophole, click on the button below to book a call with me. Thanks for tuning in. I'm Sonya Moreno, CPA.